Cashflow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Good evening. Welcome to Oregon Cashflow Pro. My name is James Barber. I'm here to help you maximize your cash flow. Let me fix my lights over here. They're falling down a little bit. All right, that looks better. How's everybody doing tonight? This is our Wealth Care Wednesday live stream where I'm here to answer your questions about anything finance. So if you've got questions, I'm going to do my best to help you out, provide you with some value, see if we can help you maximize your cash flow. Woo Steezy, how you doing this evening? So feel free to put any questions in the chat. These live streams work out best if you guys have questions. You got to pull this information out of my head. It works out pretty good, and I find that it's a lot more enjoyable than just me trying to come up with video ideas, not knowing what you guys actually need help with out there. So this is the purpose of our Wealth Care Wednesdays. Take an hour out of your day. Figure out what's going on in your financial life and what can we do to make it better. Where can you make it better? Are you guys working with budgets? Have you done a budget to see where your cash flow goes? Where's all your money currently going? Does it does it go away quicker than you expect it to? Have you gone through your finances and your budget and looked to see where all the money just kind of leaks away? Oftentimes, in this day and age, we sign up for so many different services. All the different services are switching over to subscription type services. And so we end up signing up for so many different services and we kind of forget about them. And so they just keep piling up, and it can be a substantial part of our income that ends up coming out in these extra services that we're not even really using. Before I go any further, give me a shout out. Let me know that you can hear me. I hate when I'm talking for long periods of time and YouTube hasn't put me on live. It looks like we're good though. It looks like we're on live. Darius, how are you doing this evening? How are things going, my friend? I'm assuming you guys can hear me okay. It looks like everything's functioning. Give me a thumbs up in the chat. Just let me know. I know we've got some folks on there. How's the stream look? Is it blurry? BDN, how you doing, man? How you doing? How's the full self-driving going? Is it getting better? Have you had any updates? Inquiring minds want to know. It looks like my feed might be a little fuzzy. Does it look fuzzy to you guys? I'm going to check it on my phone here. It might always be fuzzy on this part that I have to look at. Oh yeah, everything looks good on my phone. I'm assuming everything looks good for you guys. You guys just aren't very talkative tonight. We got a lot of things going on out there. It's earnings season. Thanks, Darius. Appreciate that. It's earnings season. A lot of companies bringing in record profits. Stock prices are going up. Insurance is going good. Insurance is busy for me. I mean, I guess I kind of answer your guys' questions all day long throughout our meetings, so we don't end up with much left over here for our live streams. Tesla employees have the FSD version 9. It seems nice. Nice. Do you still have the version 8 for now? I think the version 9, Elon was just saying it's coming out to a wider audience in 2 weeks. And I'm assuming that's the first one that does away with the radar. I had to get my windshield fixed. You got the 8.2, nice. I had to get my windshield fixed on my Model Y. We had a rock chip, and it ended up cracking. So I had to schedule a service appointment. Just scheduled it on my Tesla app. Unfortunately, the service center's in Portland, so I had to drive to Portland. I could have had it fixed by a glass place down here, but I would still have to take it to Tesla to get the cameras recalibrated. So I just scheduled it with Tesla. Went up. They gave me a loaner while my car was in the shop. And 3 hours later it came out. But during that 3 hours, that loaner I got was a Model S. Pretty nice vehicle. But I gotta say, I like my Model Y a lot better. It's just, maybe I'm used to it, but it was a lot more comfortable. Also, the Model S was set in chill mode. I couldn't change it. I didn't get to drive it a whole lot, but just a different feel. The seats feel a lot better in my Model Y. Like, that Model Y is like that thing's the best car I've had. Best car I've owned, and I've owned a lot of cars. BDN, yeah, you think the S is too big. Yeah, that was kind of the feeling I got too. Although the S had a roof on it, and my Model Y has glass up above me. And so the Model Y feels a lot bigger. Just spaciousness. Feels more spacious inside. So, I thought that was pretty interesting, though. I expected a little bit more from the S. So, we'll see. The S and X refresh, I bet people are really ready for that one. Although maybe the buyers for the S are used to those larger cars. Andre, how you doing, man? Checked YouTube before sleep, and there I am live. How you doing? Thanks for stopping by. Hard MF, how you doing? Good evening. Be sure to hit that like button on your way out. Way out west, good evening. Be chatting with you tomorrow. Andre, things are good. That put. So I ended up buying a number of puts today during our live stream, right? Well, I had to manage it throughout the morning in between my meetings. And every once in a while I bought and sold as it kind of went up and down. But I was basically negative for the whole day until right near the end of the day. Turned it positive, ended up making a couple $100. So that worked out pretty good. Hard MF, the topic tonight, as with all our Wealth Care Wednesdays, is a Q&A. It's whatever you guys want to talk about. You ask the questions. I'm going to do my best to answer them. Hopefully, provide you with some insight on maximizing your cash flow. We talk insurance, we talk mortgages, we talk credit scores, credit cards, rewards, real estate, business, taxes. You got taxes coming up. Did you figure out what you're going to do for the taxes yet? Going to hold off and hope Tesla comes up next week. It might come up sooner than expected. Like sooner than I expected. It's been finding a lot of strength. It went down a little bit again after hours tonight. But surprising a lot of strength yesterday, above 700. And then it was a battle just to get it down to 695. Like I think a few months ago, or even end of last year, it would have blew right through that on the way down after earnings. We would have been way lower So something's changed. Something's a little bit different. And it's kind of cool. Like, I'm not expecting us to drop down a whole lot. Although, somebody could force it down and then kind of that whole attitude changes. But right now, it seems like a lot of people are supporting it right around the levels it's at. Way out west, what's the reason for my focus on Tesla? So, it started, was it a year and a half ago? Maybe just over a year ago. Just over a year ago, I test drove a Tesla. I've been kind of wanting to drive one just to see how it is. I've heard good things about it, but it wasn't really like burning. Well, I sold an insurance policy in Arizona, and this was right before all the lockdowns started happening. And at that time, when I would do a policy, I'm selling policies across the country, and I was still hand delivering them. So I would get a policy. I got a policy in Arizona. I flew out there to hand deliver the policy. I did a policy in Idaho, drove out there, hand delivered the policy. So I flew out to Arizona, and I took that as my opportunity to finally test drive a Tesla. So I rented it on Turo, got to drive it from the airport. I flew into an airport that was like an hour away from the city I needed to go to. So I got to drive it for a couple hundred miles, and like, I knew right then I was going to have to buy one. And when I decided I needed to buy it, I started looking at the stock, and I came across some YouTube channels where they were mentioning that it was going to be coming up on a possible S&P 500 inclusion, and so that kind of drew me in. And at the time, I had only been trading like $5 stocks or less, penny stocks essentially. And it totally changed me. Like, after driving that, I started paying attention to Tesla, started watching the stock, bought a couple of the stocks, and then I started realizing, oh, this S&P inclusion is going to be a pretty big deal. Like, this share price is going to shoot up. And so I started paying attention even more. And right before the S&P inclusion, a little while before that, I had just passed over 1,000 subscribers on my YouTube channel, and I decided I was going to live stream Tesla's earnings call. I think it was the earnings call. No, it wasn't the S&P 500. It was the split. It was the stock split. So the stock split came up, and so I decided, you know what? I'm just going to live stream this stock split. I put out a video about the stock split over the weekend, and I ended up getting more views on that video than any video I had done to date over the last 2 years. And I was like, wow, people are really interested in hearing about Tesla, and especially around the stock split. So I had used that as an opportunity to pitch the live stream. And when I did the live stream, I had a ton of viewers show up and a lot of people subscribing. And I suddenly went from like 1,000 subscribers to 2,000 to 3,000 to 4,000. And it just started climbing once I started talking about and paying attention and reporting on Tesla. And so from then on, I basically, after that stock split, I decided, based on the conversations I was having with folks, that I would just keep doing the live stream, and we would just watch the stock market, start trading, and most of the people came to the channel because of Tesla. So I just keep Tesla up on there. And so it's kind of my main focus as far as the stocks go. I like to day trade with Tesla. I like to use options on Tesla. We talk about other stuff, but Tesla ends up being the main focus, mostly just because that's kind of what brought everybody in together. And we've got this really great group on Discord. Anybody who joins the channel as a channel member or a patron can join our Discord. And we talk about stocks in there, cryptocurrencies. We talk about, all of this other stuff too. So real estate. Basically everything. Hand deliveries. I had more time. I had a lot more time then. These days I can't do it. I just don't have any time. My days are totally booked with meetings day in and day out. And so like it's not even possible that I could do hand deliveries. But yeah, I was doing hand deliveries, and it was a lot of fun. But when my YouTube channel took off, so did my schedule. And now my schedule is filled with meetings day after day where I'm helping people out. And it's a much better use of my time. Much better use of my time. Yeah, the Tesla live streams are definitely more than just Tesla. I talk about options. I basically try and show people how to day trade, or at least they can see how I day trade. And we talk about reading charts and the technicals. A lot of things that people new to trading should pay attention to. Philosophy around trading, ideas on it. We play the quarterly earnings calls for Tesla. We talk about a lot of stuff. Basically, anything I can do to help bring value to you folks, I try and do it. So that's where this live stream came about, our Wealth Care Wednesdays, where basically we talk about anything you guys want to talk about. Hopefully, I can help provide you with some value. And the live streams opening the market, I'm trying to help people while also feeding my desire to watch the stock market. and figure that thing out. You know, I mean, it's been a learning process. We've all been growing together. So it's been pretty cool. All right, Andre says, you bought also some shares. You hope it will not drop tomorrow. Big hopes for Green Thursday. Thursdays are usually pretty good, so let's hope so. Heart MF says, can I start a Roth IRA for your kids? They're 6 and 8. So yes, you can start a Roth IRA for your kids. However, you can't contribute to it unless they have earned income. So that doesn't mean they have to go find a job. You can give them a job. If you have a small business, you can put them to work. If you do anything where you can actually put them to work, if you have anything like a business, drive for Uber, you know, whatever, have a YouTube channel. Maybe you do videos on YouTube. You can use them as models to take your thumbnails, you know, to be on the thumbnails or whatever. There's all different kinds of ways that you can basically hire your kids so that they can make some money. Now, it's going to depend on which state you're in as to how much you can actually pay them without them having to file taxes or pay any taxes or pay any Social Security or things like that. And so there's this loophole basically that a lot of people can use to hire their kids and offload some of their income, because you get to write it off as an expense. If you got a business, you get to write it off as an expense, but they don't have to claim it and file taxes against it. But you can put it right into a Roth IRA for them, and it can start growing tax-free for them for the rest of their life. So it's pretty cool. Definitely suggest you look into that if you have the ability, and I'm sure you have the ability to be able to fund that thing. So yeah, and what you would be starting, you would be starting a custodial account where you can trade with that Roth IRA too if you wanted to, so that you can help to grow it. Or you can just start a Roth IRA in like a thing like Acorns, where you just put the money aside and it'll grow however they invest it, right? I have an Acorns account, pretty happy with it. I started it last year. I'm up 25%, and I haven't had to touch it. So it's kind of cool. It's kind of nice to have that little bit set aside to be able to do that with. But they do have the ability to set up retirement accounts in there. You could do a self-directed Roth IRA, or even for them, you could just go through whatever brokerage firm you use. I just set one up, another one for me, using Tastyworks. And Tastyworks allows you to do all the options trades with your IRA, with your Roth IRA and your IRA. Pretty awesome. They're like the most lenient when it comes to that. I'm going to have to move my Webull over there because Webull doesn't let me do any options trading in my retirement account. And I want to sell covered calls on stocks that I own. So I'm moving over to Tastyworks to be able to do that. If you want to check out Tastyworks, I'm going to post my referral link in the chat here. The referral link, you'll have to let me know what they offer you. I I don't know what they offer you because I just got signed up for that. But the offer that I got, I will let you know what I put into the offer thing. It was 100 shares or 10 to 15 options. And all I had to do was fund it at $2,000. Now I had to fund an individual account because they can't give you that bonus inside of a retirement account. But all I had to do was put $2,000 into a regular account and I get that bonus. So it was pretty awesome. So check that out. Andre ended after hours with 0.014% green. All right, cool. Right before the end of after hours, someone pumped it back to green. Good, good. Andre, 722 is your average. If tomorrow goes there, would be amazing. Oh, good. In retirement accounts in the low 600s. Nice, nice. Way Out West says, good to know the live streams are more than just Tesla. Okay, I got that one already. Hard MF, really hoping it gets back there by the end of the week. Got to sell to pay your 2020 taxes. Oh, I missed the amount. Oh, you're hoping Tesla gets back to 720 to 730. All right, good. Me too. Me too. Oliver, good evening. Good evening. Yeah, taxes, nobody likes them. They're kind of a necessary evil. Hard MF, your average Tesla price in your IRA is around $200 per share. Nice. Your non-IRA average price, $740. Yeah, you've been trading. You've been trading outside of it, for sure. Andre, and it should be the opposite. You should have been trading inside your IRA, so you don't have to worry about all these taxes. Andre, you think tomorrow will tell us there will be pinned, where it will be pinned based on the options? Yes, I plan on looking at that and figuring out where I expect it to be pinned. As of today, I'm expecting the 700 strike price. It's going to be either just above or below it because that's going to be like the biggest number. Anytime we're close to that, it's going to be the biggest number with as far as options for calls and puts. And so most likely that'll be the target. But Thursday helps to determine that because Thursday can really move us one direction or the other. And then we got to reassess because it's on Fridays, it's likely to hit closer to wherever it ends up on Thursday. So Thursday can definitely change it. Oliver, here working out at the gym, now open again. You gained 11 pounds, trying to lose some weight. Nice. I went to the gym for the first time just the other day. Although I bought a treadmill and I've been walking on it here because I'm trying to lose. Apparently I'm down to 10 days until my vacation. And I waited too long. I'm not shedding this weight quick enough. Not shedding the weight quick enough. Hard MF. So you can start it and you can pay them. You're an S-Corp general contractor. Yes, absolutely. Very good. Check with your CPA on how you want to do it. Yep, you won't have to have them pay Social Security or taxes. It depends on your state, but like if it's just the federal limit is $12,000. So you could pay each kid $12,000 as long as they're doing actual work for it. You can't just pay them and then not do any work because otherwise you get audited, you might get in trouble. You want to actually give them some kind of work that you can actually claim some expenses, but planning ahead helps out a lot. Up to $12,000. Now here in Oregon, there's a state limit and it's $2,000. So if I'm going to do something like that, and I haven't done it yet, but if I'm going to do something like that, I'm going to probably keep it under $2,000 because otherwise I got to worry about workman's comp and all kinds of other stuff that if you actually have employees, you got to worry about. So Acorn's good. You're up about 25% too. Nice, nice. You're thinking about converting some of your IRA to self-directed, do some real estate. Okay. I don't know if you can turn that into a self-directed 401k, but if you can, you should look into that. Because if you have a self-directed IRA and you want to do real estate, or there's other things you can do too, but if you use leverage, you end up paying UBIT tax, which is unrelated business income tax. And it's really stiff. It's like 45-50% tax. So if you want to be able to buy some real estate and use a bank to get leverage, you can do that with a self-directed 401k it's called the solo 401k. So if you're the only employee of your business, I mean, the kids count fine as well. You or your spouse can be the owners. But if you're a solo owner, just you and the spouse, you can do a solo 401k and you can get a loan with that. So you can use $20,000 of money in your 401k and $100,000 or $80,000 from the bank and buy a $100,000 property inside your 401k, and you don't have to worry about that unrelated business income tax. So it's pretty cool. Definitely check that out if you have the opportunity. Oliver, how much quarantine weight did I gain? Oh gosh, I don't know. Like 13 pounds, something like that. Andre, how long will I be away? I think we're going to be gone like 9 days. Something like that. Going to Mexico. We're going to go to... Where is it? I forget what it's called. Playa something. Just south of Cancun. South of Cancun. We went near there for our 15th wedding anniversary. And it was awesome. The snorkeling was amazing. We went to some places there where we got to go inside some caves. I'll definitely be eating. It's an all-inclusive. Playa del Carmen. Yes. Playa del Carmen. Thank you. That's where we're going. We're going to an all-inclusive there. And we're going to do some excursions as well. So, even the gravel pit ponds are beautiful. Nice. Nice. Yeah, so we went to Puerto Aventuras the last time. That was our 15th wedding anniversary. That was really cool. We enjoyed. We went down to, where is it? They had the ruins down there. We drove an hour or two to some Mayan ruins, I think it was. That was pretty cool. You did some work in Playa. Nice, nice. Well, I appreciate you sending me that link the other day, too. It looks like where we're going, everything's nice and safe. But that was a lot of good information. A lot of good information on where to be, what to watch out for, and how to be safe in Mexico. Oliver, stocks got you all sitting idle, eating, and making profit. That's good. As long as you got that making profit part in there, then that's good. You don't want to be just sitting idle, eating, and losing money. Way out west, Verizon and AT&T work well in Mexico. You struggled with Sprint, so you switched to Verizon. Okay, good. I have AT&T, so. Andre, no live stream for 9 days? No. I'm going to probably try and do something while I'm down there. I'll be checking in. I do have some videos set to be released while I'm gone, but they'll be mostly clips from our Wealthcare Wednesday live streams. So whatever my editor puts together that I've got lined up will be coming out, probably mostly having to do with insurance, but really whatever topics we talk about here, I have her editing and turning into small clips that I can release so that people don't have to sit through a whole live stream just to get an answer on one little topic. So it seems to be working out pretty good. AT&T is the best U.S. carrier in Mexico. I'm in good shape. Oh, nice. Nice. I'm not used to AT&T being the best anywhere. Usually I'm wishing I had Verizon. I will try and do some live streams from down there, though. And if I can do a live stream while I'm snorkeling, I might give it a shot. I don't think I'll be able to, though, because I don't think the signals are going to carry too well. But I will record some video. I'll definitely record some video, and maybe I'll get a chance to upload it while I'm down there. Oliver, can I bring you to Mexico? No way, man. No way. Me and the wife. Me and the wife. Krish, how you doing? Good evening. All right. Do you guys have any financial questions to throw at me? We talked Roth IRAs. I gotta wet my whistle. I am having a good day. I had a better day trading today than I did yesterday. Yesterday was a rough one. So I've been taking my time trying to day trade Tesla. Sometimes it goes good, sometimes it doesn't. Challenge for me is I have meetings throughout the morning while the market's open, and so I can't always watch it. And I get myself into a trade, and I've got a set amount of time that I got to get out of it. And it's really hard for me to cut my losses short quickly, which is like the number one thing that you want to do if you want to be successful at day trading. You want to be able to cut those losses as soon as it moves the wrong direction. As soon as it moves, like if you get into position and it moves the wrong way, get out of it. You got it. You made the wrong call. And I'm getting better at that. But sometimes I miss it. And then suddenly I find myself thinking, oh, it's going to come back. I know what it's going to do today. And then it just doesn't quite do it. So I ended up losing like $4,000 yesterday because it moved way against me. And I had meetings coming up. And I'm like, this thing might just keep going up. And I'm in way too big of a position at this point trying to chase this. So I got out and I figured I'll just get back in and I'll make up for it later on. I got back a little bit, but nowhere near what I needed. I started off the day in the positive too by like $600 or 1,000, somewhere around there. So it wiped out all my profits I had already made. And sure enough, as soon as I sold out, it started moving the direction I wanted it to go. And I would have been better off holding. And at the end of the day, I would have actually made all of that money back if I had just held it. But I had too much other stuff going on. I just don't know if I'm going to have the time to be able to do that or where it's going to go. So I'm trying to get in and out really quick while I'm doing the day trading. I was much more successful today, even though I did end up chasing again today, but I held out and I ended up making a couple $100 at the end of the day. Krish, your SNDL call expires on the 30th. $1 call. Your average is 0.03. What do I think? I'm not sure what that means. You paid 0.03 for those calls. I'm thinking that's what you're saying. You paid 0.03 for those calls. It expires tomorrow. And SNDL is, where's SNDL trading at right now? Let's take a look. SNDL's at 93 cents. I think you're going to be out of money tomorrow. I would sell it and get what you can if you can. I mean, that's what I would be doing with it. Otherwise, it's got to move up over 7 cents. It's got to move up over 10 cents by tomorrow for you to make some money. The 30th is in 2 days. Yeah, but 10 cents. I mean, you got to go up 10 cents in 2 days. And SNDL has not really been moving that much, has it? Let's see. It's up 6 cents this week. It's up 6 cents on the week, and you need it to move 10 cents in 2 days. Yeah, tomorrow's the 29th. Yeah, you're right. You do have 2 days, but you're losing value fast. If it's 7 cents away going into the last day, you're not going to get anything for it, you know? Or if it's still 10 cents away, it just gets harder and harder. Ideally, if you're buying calls and it's the week of expiration, you want to get in and out of that stuff quickly. Were those from on the table? Yeah, I don't need those. So if you're buying calls, one, try not to buy the calls that are expiring this week or the week of. You don't even necessarily want to buy the calls expiring in 2 weeks if you can avoid it. You want to give yourself a couple of months, maybe more if you can, if you're buying calls. If you give yourself a couple of months, you're giving yourself time to move without that time decay going away. You can still take advantage. You don't have to hold it for 2 months. You might only hold it for a day or two or a week. but you're not going to lose that time value. And if it goes up, you still get the opportunity of it going up. Now, that can be challenging depending on what stock you're buying, making sure that you have enough money, because it gets very expensive. It gets very expensive as you go longer. So the other alternative, if a stock is too expensive and you want to own it, you could buy a debit spread. You could buy a debit spread, and that's basically you buy a call and you sell a call right above it, a little ways above it, and that offsets your cost. And it ends up being a very affordable option at that point. And those ones, you can easily double your money if it moves in the right direction. Whereas if you just buy a call to double your money, it might have to move a lot further. Oh, yeah, you do need margin for advanced option stuff. If you're on Webull, that might be tough. Yeah, margin needs 2K. Yep, you're right. You're right. You might be limited there. So just be careful how quick. Oftentimes, you're better buying the shares than the option. So like SNDL, probably better buying the shares than the option. Because SNDL, it has to move through that strike price. And sometimes it just doesn't move very much. SNDL traded for months and months and months between 50 cents and $1. Now, if you've only gotten into the stock market recently, you've seen it over $1. You've seen it up at $3 briefly. And so it might seem like it can come right back there. But it traded for a long time under $1. So it's comfortable down there. Be careful. Be careful with those options. Tala, good evening. Do I think Tesla will be green tomorrow? It could be. Could be. Way Out West says, when you evaluate or present policy illustrations, do I request or present the low, mid, and current dividends, or just the current? I usually just do the current. Now, I do make sure when I'm talking to people that they understand that the illustrations in general are just a projection of what could possibly be. We don't know what's going to happen going forward. The illustrations have a guaranteed column and they have a current column. They have an alternative column too, which shows all three. So the all three get represented. The alternative, though, is just like the exact middle in between the current and the guaranteed columns. It doesn't really mean anything. The guaranteed column doesn't really mean much of anything because we're going to automatically do better than the guaranteed column. If we have a whole life policy, the guaranteed column assumes no dividends ever and maximum insurance charges. Well, the carriers that we're using have been paying dividends for 150 plus years, every year. So odds are, and we already know they're going to pay a dividend the first year. Odds are they're going to pay a dividend the second year, in which case that guaranteed column is blown out of the water. And the odds are they're going to pay dividends every year we own the policy. I mean, that's why we get into those ones. On an IUL, the guaranteed column assumes zero return in the index every single year and maximum insurance charges. We know that's not going to happen. An index, the beauty of the IUL, when an index drops, you get an annual reset. So it's not like you're in the stock market, where if the stock market loses 50%, you have to get 100% to get back to even, and then you start making money. With an index universal life, as soon as it starts to go back up, you get to go back up because you get that annual reset. And we don't usually see the stock market go negative year after year after year after year. It's usually a big drop, and then it takes a while to get back up to even. But in an IUL, you're going to get those gains each time. So I don't put much stock in the guaranteed columns of those. I don't worry too much about those being the reality. The actual current column, probably going to be closer to reality because we're in a low interest rate environment. Dividend rates have been coming down. I think down the road, dividend rates are probably going to be coming back up. Or they're going to be kind of hanging out around where they're at right now. They might still come down a little bit, but there's not a whole lot further lower that they can go. So I don't really worry too much about variations in that. If we design the policy right, the costs are minimized. Even if we just get some growth in those things, they're going to be pretty good. They're going to be pretty good performers. So I don't worry too much about those other ones. But I do like people to understand the limitations of the illustrations that we're showing. Because the limitations are, we've got to put something in here so that you can, one, see what's possible, what might possibly happen in this thing. And we go based off of history and what's currently happening. And then two, you've got to be able to compare it to other companies somehow. And so the good way to compare it is, what is everybody currently paying for dividends? What are the index options they're currently doing? What are the historical returns for those index options currently? So there's value in it, even though we can't really, I mean, we know they're not actually going to happen that way because they just can't. They assume the same rate every single year moving forward. That's just one of the limitations. So as long as we take those under advisement, we realize that we have the ability to manage these policies, manage the costs in these policies if necessary. There's ways to get out of these policies if necessary. If somebody comes out with just an amazing product and you're like, oh, I wish I had that one instead. Good news. We have 1035 exchanges. We can move into those ones. If they're that great and it's worth it, we can do that. So there are ways to mitigate any of the risks inside of the policies that might present themselves. So knowing all of that, it makes it a lot easier. It makes it a lot easier to take the illustrations and understand them for what they are, which is what we can use to compare them to other companies. Let's see. Good question, though. Good question. Key Perry, how you doing? It's been a while. Thanks for the high-quality discussions each week, she says. Love listening to the playbacks. Thank you. I appreciate that. I appreciate that. It really does make me feel good to know that I'm providing some value. So, Way Out West, thank you. I appreciate the tip, the super chat. What are my thoughts on Lafayette for whole life IBC? So I'm not contracted with Lafayette, so I don't know how to design their policies the best. But the ones that I've seen and the people that I know that sell those tend to design 60-40 type of policies, which I'm not a big fan of. 60-40, 70-30. So I don't know if they offer the ability to design it better. And when I say design it better, I mean like I like liquidity in my policies. I don't like to tie up money. A lot of the people that work with me are real estate investors, stock market investors. They don't want to necessarily tie up their money either. They want it to be available if there's an opportunity. And it's really challenging if you're getting a policy that's designed to tie up your funds, a large chunk of funds, if we're doing a big policy, for a year or more. So I do some very large policies for some people. We do $100,000 a year, $160,000 a year type of policies. These are people that want to have access to that money because what is the difference between let's go over the life of the policy. For one, when we design it properly, we're going to get a really good cash value growth. And under the assumptions that we have now, the cash value growth is going to be better than the other designs. Things have to change. Dividend rates have to go up in order for that other type of design to get anywhere close in cash value to what we have now. Much less do better than it. Things will have to change drastically. So, I don't worry too much about that, but people don't necessarily want to give up access to $60,000 on the off chance that they might end up with a slightly better return in their life insurance policy over the course of 30 years. When that $60,000 could be the difference between a deal that nets them a 300% return or no deal. So I get people that have to make those kinds of decisions, you know. Now, if you're somebody that just wants to put money in a policy and not worry about it, you're not doing outside investments, it makes a bigger difference, right? It might make a much bigger difference. But for the most part, even if you're going to let it sit in there, we get a lot better cash values. So what I would like to do is I would like to be able to design a Lafayette policy to see how good I can make it. Because I don't want to just go off of the assumption that these other agents are designing it the best that it can be done, and 60-40 or 70-30 is the best it can be done. Because no matter what carrier it is, every carrier I have access to, if I can design it to be higher cash value in the beginning, it ends up better down the road. I haven't seen an illustration yet where it ends up much higher cash value when it's designed with lower cash value the first year, which inevitably gives me, the agent, a lot more commission because the costs are just so much higher in the policy. So hope that helps. Hope that helps. Krish, what do I think you should do? Sell it open? No, not necessarily sell it open, but you want to watch and see what you think it's going to do. So check out the charts. I haven't looked at the charts on SNDL. See what you think that it might be doing, which way it might be moving. If it looks like it's going to move up, then obviously you can wait. But if you're not sure if it's going to trade sideways or down, you're just losing time value. And it's probably not going to be worth it to hang on. Like, it's going to need to move a significant amount in order for it to get above that 3 cents. And right now, if you were to sell it, you'd probably only get 2 cents for it. So it's a tough situation. Good news is it's not very much money. It's not like the last one that you got into where it was a much bigger difference. With this one, not very much money. So hopefully it'll work out well for you. Tala, when is NEO earnings coming out? I think NEO does their earnings tomorrow night. Same with Amazon. David, Biden is talking very good. My show is at a bad time today. I'm competing with Biden. Okay, no wonder. Babra, have I ever dealt with any variable universal life? And what are my thoughts? I have. I used to own a variable universal life policy. It did okay. It wasn't terrible. But at the same time, I'm not a big fan of them because the fees are higher than if you just invested in the stock market. You're paying for life insurance and you're paying higher fees to be in whatever funds that they're in. You're also dealing with life insurance agents. Now, these are people who have gone through and got their securities license. But more often than not, they're not professionals in the securities field. So the illustrations I've seen lately from people doing variable life policies, it's like spray and pray with what they're putting people into. It's like there's 100 different indexes you can choose from, and they're putting 1% in every single one of them so that they don't have to worry about your policy. It's not designed with any sort of focus in mind. It's not taking into account what types of markets we're facing right now. It's just throwing it in a whole bunch of stuff so that some of the stuff's going to go up sometimes, some of the other, and you're just going to get the average. So I'm not a big fan of that. And why should you pay extra for that? I mean, in that case, I would rather get a term policy and just invest in the market if you wanted to be exposed to the market. Or even better, I would go with an index universal life policy where you get guarantees. Because in the variable one, there's no guarantees that it's not going to drop. You get 0 guarantees that it's not going to drop. If the market goes down, your account goes down. My grandparents, my wife's grandparents, took their retirement money and were sold on one of those variable universal life policies. They thought they had enough money to last the rest of their life. This was right before 2008. They got talked into putting all of their retirement money into one of those. And then it lost half of its value. And they ran out of money and had to go bankrupt. They did not have enough to live on for the rest of their life because it was a terrible time in their life to be put into that product. That was a terrible decision by that insurance agent to sell them on that product. You don't take somebody that's in retirement and put them and expose them to all the risks in the stock market. knowing that they do not have the time to wait for the market to come back up if it drops. On top of that, you don't put them into a product that costs a lot of extra money too to be exposed to all that risk. It was just a bad decision to begin with. There could probably be a place for it for somebody if they fit the right client. But I don't know who that person is because I don't sell that product. Okay? But I know there's a lot of people that is not a good fit for them. And I just don't even want to touch them. So that's where I come from. That's where I come from on that. I had one. It did okay for me. I bought it when I was really young, though. Right? I bought it when I was young. I funded it for a little while. I stopped funding it like people do, like young people do when you got other things that you want to put your money into. And it carried itself for a long time. It paid for itself for a long time. I had a little tiny bit of cash value I took out of it, and I canceled it. And I ended up opening up some whole life policies. I opened up some IUL policies instead. And I'm glad that I did that. I'm glad that I ended up doing that. Good question. Key, anyone in the chat familiar with all-wheel drive cars? You got a nail in one tire. Can you buy one tire, or do you need all four? You don't want to get taken advantage of. Good question. So it depends on how much wear and tear you have on your other tires. It is a challenge. You might need to replace 2 of them. If you have significant wear, you can replace 2 of the tires as long as there's good tread still on the other 2. You're going to end up getting yourself probably into a cycle, though, where you just replace 2 at a time. So it's going to really depend on how the rest of your tires are wearing. I'm not a tire expert. That's just my understanding from all the experience I've had buying tires and having issues with them. Mr. B, good evening. Way out west, old fogies like me put a bit of weight to legacy planning and death benefit. How long do you think it will take for dividends to start climbing? My best guess, we got at least 10 years. I think we're in a low interest rate environment. Most insurance companies, they make their dividends, they make their profits off of very, very long-term investments. And those investments start a long time ago. So we started moving into this low interest rate environment 10 years ago, 15 years ago. It's starting to catch up to all these insurance companies. That's why we're seeing their dividend rates coming down. They kept them up as high as they could, but they are still coming down. They're getting to a point where the dividends that they're getting into, or the investments that they're getting into, there are some investments that they're getting into that could return a little higher amount. They're kind of getting used to being in this environment and knowing that they need to be in an investment that's going to get them a better return. And so some companies are able to do that. Some companies are able to manage that. Some aren't. Like Ohio National is turning into a stock company from a mutual company because they can't hack it. They're not able to afford paying out the dividends. And so what's going to happen is they're going to buy out any people that want to get a buyout. They're going to give out stocks to some of their policy owners. But moving forward, those policies are only going to pay out the bare minimum. They're just going to get the guaranteed rate. Because at that point, dividends are going to be split up between stockholders and policy owners. So it's kind of a bad situation. That's going to happen to probably some other companies that are struggling as well. The top carriers that we're looking at, they're still paying high dividends. The dividends have come down slightly, but they're still paying dividends well over that guaranteed rate. I expect those to continue. Mass Mutual pays the highest dividend out there, although not necessarily technically because they just announced the highest gross dividend. They are still one of the top ones out there when it comes to year after year potential growth, but not necessarily the highest. But they report the highest dividend, and they've recently invested in Bitcoin, like $100 million in Bitcoin. I think that's a good move. You know, insurance companies are very conservative in their investments. So that's a bold move that I think is going to end up paying off for them in the long run, and they'll be able to keep paying those higher dividends because Bitcoin's going to provide a really solid return over the next 5 and 10 years. So insurance companies are going to be making those adjustments. But at the same time, The interest rate environment overall, I don't see that changing very much. I mean, low interest rates is the only thing keeping this economy going. If it goes up, stock market's going to crash, politicians are going to get fired, and one of the things that they do, they don't like to get fired. They like to get reelected every year, and the economy performing is one of those things. So pressure is on to keep interest rates low. We're just not in an environment that can absorb a higher interest rate without it crashing the economy. So I don't think that's going to happen. I just don't think it's going to happen. We might try and ease into it a little bit over time, but it's going to take a long time. So that's why I think at least 10 years is our horizon. So if it takes at least 10 years for dividend rates to go up, that's 10 years of growth and gain that a more efficient design policy is going to be outpacing that. It's going to take a lot longer for it to catch up and surpass it once the dividend rates do start to come back up. And for the most part, I don't think most of them will ever come back and catch it. So, good questions. I'm supposed to listen to Biden tonight? Nah, I'll just get the Cliff Notes later. Chris, you have no clue. Can you take a look at it? Oh, it's worse. You blew your account. This is all you have left. Chris, why don't you sign up for a one-on-one with me? I'm going to post my Calendly link in the chat. Go to that. Do a 10-minute call with me. Okay, there should be a 10-minute call available before I go on vacation. There might even be one available tomorrow. Do a 10-minute call with me. I might be able to help you out specifically. It's really hard for me to do if we're just doing it through the chat because there's too much delay and I can't get enough specifics from you. You'll have to type it all in. It'll be a lot easier if we can do a one-on-one. I'm definitely happy to help you out. I hate hearing that your account got blown up and you're running on fumes. So let's figure out what we can do to salvage what you've got left. Okay? I'm definitely willing to help you out if I can. Key, do I recommend someone get disability insurance in addition to whole life and or IUL? Can I talk through my reasoning? I'm not real familiar with disability insurance, so I'm not the best person to ask. I know people that sell disability insurance would say yes, of course. But there's a reason people buy a lot of disability insurance. I also hear from people that don't sell disability insurance that it's important. I think it's more important for certain people than it is for others. It's more important for people who work and rely on their ability to do physical labor. I think it's more important for those folks. Disability insurance can pay out. It can meet a lot of needs. It can meet a lot of income needs that whole life and IUL will not. So we do have some living benefit riders available in whole life and IUL, but those don't pay out just for disability. A waiver of premium rider in a whole life or IUL doesn't pay out for disability. It doesn't cover your income needs. It can help cover a premium, but it doesn't cover your income needs. So yes, there can be a good need for some disability insurance, I believe, but it's going to be a personal decision based on how much of your labor do you need to cover. Like, what is your financial stability if you were unable to work? If it's going to go to crap because you don't have enough savings, you probably have a greater need for it. If you have a lot of money saved up in the stock market, if you have money in a whole life, if you have money in an IUL that you have actual access to, should you need it, maybe you got less need for it. But I definitely think it doesn't hurt, or it wouldn't hurt to talk to somebody who specializes in that and find out what is the argument for it. What's the best case? What's the best case that they can make for it as to why your particular situation might be advantaged if you had it. So, like I said, not my area of expertise. You got to be licensed for health insurance. in order to sell disability products and long-term care and health insurance, obviously. And I'm not licensed for health insurance. I wouldn't have time. I wouldn't have time to do it. With the niche that I've chosen, I'm focusing on high cash value designs and just staying on top of all of those products and all of the carriers and the changes that they make. Like, that's a handful. I can't imagine adding in all of the health products that are going to be out there among a whole bunch of different carriers, and all the upkeep that you need to know that goes along with that. So there's all kinds of different areas of insurance. I think it helps to get somebody that specializes a bit, just so that you know that they're up on all the different things in that particular area. Popeye, first time on the Wednesday stream. Good afternoon. Hey, good afternoon to you. Way out west, any opinions or experience with Primerica? They come at me from multiple vectors, work, family, and friends. Not a fan of their business model, but they have good reviews. But they also target whole life policy owners. Primerica has a well-developed and mature script to get whole life policy owners to buy into the myth of buy term and invest the rest. They stumble when you hit them with the math. Average investment returns versus actual returns is like night and day when it comes to results. Primerica is not trained to do the math. Exactly. So, for one, their insurance agents are not very experienced. You've got a multi-level marketing organization that is built to recruit people. And the people that they're built to recruit, they're expected to sell to their family and friends, and the expectation is they're not going to do much more than that. So they churn through agents. So most of the people do not know that much. So it doesn't surprise me that they're not able to deal with the math when you hit it with them, because they go through training. I'm sure the training is substantive, has a lot of good selling points in it, a lot of good talking points. But yeah, it doesn't hold up. Buy term and invest the difference. Okay, people don't really do that. People end up buying the term, but then they forget to invest the difference. Oftentimes, of that invest the difference, what part of that is going to a conservative part of their portfolio? Why wouldn't we just meet that conservative part of the portfolio with a whole life policy or an index universal life policy? Why not? Then I get my insurance costs covered. I don't have to just buy term, which is a straight expense. So term insurance, let's say you buy a 30-year term insurance. It might cost you $3,000 a year. Okay? $3,000 a year. At the end of 30 years, you spent $90,000. You got nothing to show for it because you outlived the term insurance. You might even just outlive that term insurance by a little tiny bit, but you get no benefit because it's gone. Okay? So you spent $90,000, you got nothing to show for it. If we get you into a good designed whole life or IUL, you're going to have more money in that policy than you've paid into it after 3, 4, 5, 6 years. After 30 years, you got way more money in it than you put into it. And you still have that death benefit. And that death benefit is going to be there for the rest of your life. So it can also meet that conservative part of your portfolio, allowing you to be more aggressive in other areas, allowing you to maybe get that 8, 10, 12% return that people like to talk about, Dave Ramsey, over the long term. That comes from an aggressive portfolio. But having your needs met in other areas, having the conservative part of your portfolio needs met, doing multiple jobs, meeting that conservative need, buying your death benefit, creating more cash value than it costs you, having liquidity in that account to help you meet any financial needs along the way. There's so many reasons why I don't really sell any term insurance. Now, if somebody has a need for some term insurance, I can sell term insurance. It just doesn't come across very much because when we look at the actual numbers, it doesn't make a whole lot of sense for most people. There's so many people out there, they're not comfortable investing in the stock market. There's so many people out there that realize I've got more than just a death benefit need for the next 10, 15, 30 years. I'm actually going to want to make sure that I pass on a death benefit to my kids. Okay, term insurance is not going to meet that need. You know, one of the nicest things about the insurance that I have about $2.5 million in insurance right now. $2.5 million death benefit. That gives me peace of mind, knowing that while I play around in the stock market and I run my own business and I do the investing that I'm trying to do and trying to grow this wealth, if I fail at that, my kids still have a nice death benefit as if I succeeded. I'm still going to be able to pass that on. That gives me a peace of mind that I didn't know about prior to getting myself into this position. And I'm pretty happy about that. So, something to keep in mind. Good questions. You guys have got good questions tonight. E-Bean, you loved watching one of my videos that talks about using a HELOC to fund the whole life, then borrow out of the whole life to pay back the HELOC and do it again. How often can you do it? Thanks. Thank you. That is something you can do every single year. The idea is you're going to end up paying back the HELOC, and you're going to eventually pay back the loans in the life insurance. Like that's got to be the plan in there somewhere. We can't just borrow forever because it ends up getting expensive. Now we're going to be getting growth, compounding growth in the whole life, but we don't want the interest to be compounding in there on the loans that we're borrowing. So what I do that thing. I fund my whole life policy and I borrow out of it in order to pay back or invest in wherever else I would rather have that money. If I'm doing it with a HELOC, which I did last year, funded it with my HELOC, borrowed it out, paid the HELOC back. Okay, I still make sure that I can pay for the interest costs on that loan. So it's not compounding, but my growth is going to compound. Okay, so that's one of the keys. And as long as I'm doing that, I could do that forever. If I'm paying that, and at some point I don't have to keep paying the interest costs either, because I'm getting separation with the compounding growth, and I'm not getting the costs compounding. So I'm growing. And a couple years down the road, I'm going to hit my break even, where I'm going to have more money available to me in the policy than I paid into it. And at that point, I'll have the growth that's happening in the policy will be able to pay that interest cost each year. That's my hope, is that the growth, the dividends I'm getting is going to be able to pay that interest cost each year. So I won't have to pay as much of it. I figure I'll have to pay some of it, but the amount that I'm going to pay on it gets lower and lower each year. And then at some point, I'm done max funding those policies and I'm going to start knocking off the loans. But in the meantime, I'm in my growth phase. Not everybody's in their growth phase, so it might be a different situation for folks. I'm in my growth phase. I'm putting this money to work for me. So I'm investing it. I'm funneling it into my life insurance policies so I can get that death benefit just in case something happens to me. But I'm also taking it out and I'm investing it to get faster growth. And with that growth, I'm going to use that to pay back those loans. So it's not for everybody. That's just what I'm doing. And I like people to have the idea of what they could possibly do. Okay? But you got to have some good income. You got to have some good cash flow to be able to do that. You can't just get $100,000 in life insurance premiums and not have any cash flow to be able to cover the interest costs. Because these interest costs are going to add up. They're definitely going to add up if I'm continuing to take loans out. Okay? So using a HELOC to fund your life insurance policy, whether it's whole life or IUL, it's awesome. I love it. We got to make sure we're practicing our dynamic banking, though, to keep that average daily balance down. Pay that back so you can do it again the next year. And hopefully you pay that back and you're able to throw a chunk at the loan in the life insurance policy so that you can bring that down a little bit. That way, in the next year, when you go to pay back in from the HELOC, you're not maxed out on loans in your life insurance policy. You always want to leave a little bit of room in there. It's always best to be safe. Okay? Way out west, Dave Ramsey is a loving grandfather when it comes to whole life compared to Primerica. Oh, funny. They are brutal hard sellers, and they hit whole life owners hard with scare tactics. Their YouTube training videos are brutal. That's interesting. I'll have to check that out. That's pretty funny. Thoughts and recommendations on dividend-paying stocks. Oh, wait. Back to the whole life one. I'm assuming that their attacks on it take into account the terrible cash value components of these IULs and whole life if it's a traditionally designed policy. In that case, I 100% agree with all of the criticisms that come from Dave Ramsey, and I would probably agree with them from Primerica as well. I am not a fan of traditional whole life or traditional IUL that gives you no cash value and that the life insurance agent makes massive commissions. That's one of the complaints that we're always hearing about these. The life insurance, the only person making money. The life insurance agent's the only one making money when they sell you these policies as investments. Well, one, they're not investments, okay? But they do serve a purpose. And that purpose is more of like a savings type asset. You can get growth like maybe an investment in an IUL, but the whole life is more of a savings type asset, and the IUL is even more of a savings type asset. But it serves a purpose. It serves a conservative part of your portfolio. You know, people that invest in the stock market only, they have money set aside in money markets and bonds and other things that aren't going to earn them very much. But they do it because there's a need to have some stable portion of your portfolio that's not going to lose 50% if the market drops. And that's where our whole life or our IUL can serve that purpose while still giving you other benefits to go along with it. Now for me though, it's not going to meet those needs if it's a traditional design. It needs to be that high cash value design that I like to do, right? Because they just perform better in the long run. It mitigates a lot of the risks out there. It gives you liquidity. There are a lot of different ways to put money into these things and fund it at a higher level if you're not giving up access to those funds. So I'm definitely going to have to check that out because I'd be surprised if any of those arguments hold up when you compare them with a really well-designed policy. Okay, so next question was thoughts and recommendations on dividend-paying stocks. I'm not a big fan of dividend-paying stocks. Most of your dividend-paying stocks don't have a very good return. They don't grow in value because the growth that the company experiences, it pays out in a dividend. So a dividend-paying stock might pay you 1% over the course of the year, 2%, 3%. There's some out there that pay higher. Like my favorite one is Orchid Island Capital. It's a REIT, real estate investment trust, and it pays out about a 13 to 15% dividend. 13 to 15% dividend. It's not too bad. But that's not enough for me. That doesn't satisfy me. The stock doesn't move all that much. It moves a little bit. So I buy it every once in a while. It came down in price last week. It came down to $5.08, which anywhere around $5, I'm happy buying it because that gives me about a 15% return on the dividend. I happened to buy it right at the bottom. It shot back up to $5.45 or something like that. $5.45, I think. It pays out a 6.5-cent dividend every month. That's a 1% every month. A little over 1% because on the amount that I bought it in at, it was about a 15% return. But 6.5 cents. The amount of value it went up in, 37 cents. That's 6 months worth of dividends. So I sold it. I don't want to sit on it for 6 months to watch it go up and down a little bit just to get back to where I was at like a week after I bought it. So I sold it. I'm going to put that money to work somewhere else. And I'll buy back in later when it drops back down. But I just made way more than the potential 6% dividend over the next 6 months than if I would have held on to it. So I have a really hard time buying and holding those. It also doesn't have any good options. Like I can't sell, if I could sell covered calls against it, I would probably hang on to it as a dividend stock. But for the most part, I'm just not a big fan of dividend paying stocks. They don't move very much. They do serve a purpose though. So you called yourself an old fogey earlier. It might serve a good purpose for you. You maybe are moving to a point in your life where you'd like to see a little bit of stability. You're not really shooting for the massive gainers. You know, I'm, like I said earlier, I'm in the growth phase. So I'm going to have a little different take on things than somebody who's getting to the end of their growth phase might be, or to somebody who's out of their growth phase. Now they're in their protection phase. Dividend paying stocks are good in that protection phase. The nice thing about the dividend paying stocks is they do have the ability to go up in value, and they might. So you might get the dividend and you might get some growth. So there's that. Now, I view all of the whole life policies that I own as what I would otherwise have as a dividend paying stock. So I'm putting money into my policies and I'm getting a guaranteed 4% return and a possible dividend of 5-6% or more. Now that's gross dividend. It'll look lower after the insurance costs come out, but that's pretty good. And I'm a part owner of these companies, and these companies have been paying out dividends for 150 plus years, and they have to pay out some 4% by contract. None of these dividend paying stocks have a contract with you to pay that dividend, and it keeps going down. And there can be some years where they don't pay the dividend. There can be some years where it goes up, some years where it goes down, some years you don't get anything. With the whole life policy, I get the dividend, it's guaranteed. I get the growth that's guaranteed. So it ends up meeting that need. So I'm fulfilling that need with my life insurance policies. So, like I said, it allows me to be more aggressive outside of that. I can be more aggressive in my investing outside of that, and I intend to be. Now, as if you had started a long time ago and you set it up and you got your needs met as far as dividend growth, it might give you enough dividend that it ends up paying you enough for a basic income each year. You might have that needs met and you can continue to be aggressive in other areas as well. So your situation might be different. It's definitely worthwhile to consider it among all the things and see if maybe dividend paying stocks will serve a good need in your portfolio. But if we can meet that need ahead of time and maybe meet that need with some whole life insurance, maybe some IULs, that might serve that need as well. It's not a dividend, but we're protected from the downside. And we have a lot of good potential growth. Situation might be different. E-being, do you have a calculator to measure how much to use HELOC to fund the whole life to make sure you don't overdo it? Some experts say 70-30 split versus 90-10 split. Can you explain what that is? That does not have to do with the HELOC funding. And I have a number of videos talking about the different splits and why I go with the 90-10 split. When this gets cut up into some other smaller videos, the link is going to be put right up here. You're not going to see it now because we're live. But the link is going to be right up here to some of those videos. Check those out. I recommend you go to my channel and check out the videos that I have. I probably have 10 of them that I've done on the different splits. The risks associated with it, the benefits associated with it, most everything you can think of. So definitely check that out. And if you have a specific question after watching those, come back and ask me, because I'm not going to be able to get into as much detail during this live stream as I've done over the course of all of those videos. A lot of good information to look at and consider on those videos. As far as a calculator to measure how much to use the HELOC to fund the whole life, I don't have a calculator. In fact, I don't think you need a calculator. The main thing is if your HELOC is a higher interest rate than your loan in your policy, you're going to, or in anything that you're trying to pay it off, you're going to want to you're going to want to take chunks out of it to fund your whole life, or chunks out of it to pay down your mortgage or whatever. You're going to want to do smaller chunks. So if it's a high interest rate, you're going to do smaller chunks. Because the idea behind using a HELOC is we're going to funnel our income into it. We're going to do our dynamic banking, and we're going to knock down that average daily balance. If we have a 10% interest rate in our line of credit, we don't want to leave a big balance in there, because we're going to knock down some of it, but we're not going to be able to knock down all of it with our income. If it's a nice low interest rate, you can use more of it. We always want to leave some to help cover any emergency costs that we might run into. Okay? So if you do, I would probably recommend not doing more than 80% of whatever the value is. Okay? And getting up to 80%, like, that's pretty aggressive. And I would do that if you're knocking down debt that has a much higher interest rate. Like if you got credit card debt that you're paying 18% or more in, I would borrow out maybe the whole thing out of the HELOC. Not get rid of that credit card debt. Because a credit card you can use for ongoing monthly expenses. You know, I mean, it can help you to maximize your practice of dynamic banking with the HELOC. Okay? If you're just funding your policy, I would probably do a series of transfers just so that you know you're going to know your overall finances. But you don't want to be in a situation where you've maxed out your HELOC and now you're in financial difficulty somewhere else. And you would have liked to have that money. Now, if you're using it to fund your policy, you're going to have that cash value available in your policy if it's designed well. So I'm not too worried about using too much to fund your policy, because you can just pull it right back out, pay down the HELOC. But if you're doing anything else with it, you got to watch how much of that HELOC that you're using, because you definitely want to have liquid funds available to cover any type of emergency expenses. Now, one of the things to consider, if you're going to be using a HELOC, you're going to be doing dynamic banking, there is a chance that you could lose access to the credit in your HELOC. And the worst time for that to happen would be right after you throw your income into it to bring that balance down. And then suddenly the bank says, oh, you know what? We're reducing your credit line. In order to make sure that that doesn't happen to you, you want to kind of pay attention to what's going on in the market. You want to make sure if the stock market's dropping, if regulations on banks are increasing, their liquidity is drying up, those are all signs that maybe, or if the real estate market drops, that maybe they're going to limit your ability to continue borrowing out the same amount you had been. They're going to reduce your credit limit available. You don't want that to happen if you're doing dynamic banking in your HELOC. So if you're paying attention, you start to see some signs that, you might have to worry about that a little bit. In that case, just borrow everything out of the HELOC. Take it all out. It's worth it to pay the interest for a month or two or 6 or a year while you're waiting it out to see how's everything going to shake out. Because I'll tell you what, if the market crashes, if the economy goes to crap, if you lose your job, if you lose your income, your ability to earn an income, you're going to be really glad that you had access to that equity and that you took it out. You're going to be in a world of hurt if any of those things happen and the bank limits your access to the equity in your home. If you've been paying on that home, you've been building up equity in it, and now you can't access it because you can't qualify for a loan. Banks aren't giving it. You lost your job maybe. You just don't have the income to support it. That happens. It happens all the time. Not that the credit limit's reduced, but that people encounter an emergency, and oftentimes that financial emergency is caused by a job loss or the economy dropping. And they don't have access to money because banks love to lend money to people that don't need it. But the people that desperately need it, they don't like to give them any money at all because their ability to repay is very limited. So take that into consideration. Be careful out there. Hope that helps. Way out west, you sent me a link for Primerica Golden Boy. Full disclosure, you have 3 RVPs in your family. You're a bucket plan investor riding the stock market to the grave. Nice, nice. Okay. By the way, have I heard of the bucket plan? Thoughts? The bucket plans that I've heard of, there's a podcast that I listen to. Jim. What is that? What is his podcast name? Jim Helps is his website. Forget the name of his podcast. But he talks a lot about buckets. I'm okay with buckets. I think it's great. I think any plan is better than no plan. So as long as you have a plan that you've identified that might meet your needs, I think that's awesome. Always good to be planning. Now, I don't know what RVP is. What is RVP? Registered Financial Planner? Is that what that is? I'm assuming that might be what it is. Registered Financial Planner? Or registered, not financial planner. Registered... I don't know what the V is. What's the V? Tell me what RVP is. I give up. We've been going for an hour and a half. My brain is starting to fry. Brian Rashetsky, how you doing this evening? Way Out West. Haven't seen a lot of split videos that show paying the base well past the max funding phase. Can the 70-30 types outperform since you have higher base funds going in the long term? No. Oh, regional vice presidents. Okay, cool. No, not at all. So it depends on what carrier you're looking at. But we can do a 90-10 split that you can continue paying for a long, long time. It just takes a different carrier. Even Guardian, which I typically, oftentimes me and Steve Parisi, we show a 7 pay, which is like kind of the most efficient design when we're trying to minimize the costs in the policy. We're trying to keep that insurance cost down. But that's not the best design in a Guardian policy, in my opinion. Like, I would rather throw in a whole bunch more death benefit and give us the ability to pay that 10x premium for 15, almost 20 years, and it doesn't mech, and it still maintains the ability to have a higher payout moving on from there. So there are different designs that we can do to meet whatever your funding needs are. And certainly, the longer you can fund it, the better these policies are going to perform. So, bucket plan is a registered trademark investment strategy. Oh, okay, then I'm not familiar with it. I'm not familiar with it. I'm just familiar with, I've heard talk of it in certain podcasts where they're talking about certain buckets. I've heard probably mention of bucket plan in some of the financial podcasts I listen to, but I don't pay a whole lot of attention to it because that's like not anywhere near where I'm at. I'm interested in doing all my own investing right now. Although I do try and create separate buckets that I'm not paying attention to. It allows me to be more aggressive in the other ones. So, all right, we are going on an hour and a half. My voice is about done. That was a lot of great questions tonight. I appreciate it. We started out slow. But a lot of great questions came in. I think we had a good show tonight. So thank you all. It wouldn't be where it is without you. Hopefully some other people can find some value in some of the questions and answers we got tonight. They're usually variations on the original plan idea. Okay, yeah. Yep, I bet. Brian, you came in late, but I'm a good man. Thank you. Appreciate that. Way Out West, thank you for your time as well. Always good content. I appreciate that. And we'll be chatting tomorrow. Look forward to it. All right, I'm going to play you guys out with some music. Thanks for joining me tonight. In the meantime, go maximize your cash flow. It's easier than you think.